So right now we're trying to figure out, like, we're paper trading. We want to paper trade Nike because we was listening to CNBC podcast, and they're forecasting that Nike is due for a tank. Like, they're due to go down. And we're going to listen, and trade, listen to what they're saying. They gave us a vertical spread to trade. Yeah, it's a vertical long spread, a long vertical to trade. That means, like, buying a Nike option, a Nike spread. We're buying it, we're not selling it. One leg we're selling, but we're buying the other leg that is more expensive than the leg we're selling. So we're gonna be putting up $250 to make this trade, $250 to make the trade, and our potential maximum profit is $750. So what we're trying to see right now is, like, how can we just, not how fast, but like we want to get out by the end of March. This is an April expiration trade, but we want to know, like, by March, what price should the Nike stock be for us to at least get 600, 500? You feel me? To get something out of it. You feel me? The max profit is 750, but we want to know if we could get like 500, 600 by March. At least, what I'm saying, 70, 80% of the maximum profit. You feel me? We put down 250. So, we also got to figure out our break even and why it is a break even. Why this price is a break even. Then we'll maybe be able to understand.
Like, because if it goes up way, like, say the jump, stop the gate tomorrow.
We want to also know our max loss and want to get out at a certain time. So we don't know what we're doing right now. We're trying to figure out, like, we need to figure that out too. Like, what, because we want the stock to go down. It's trading at like $83 right now. We want it to be trading at like 70, 73, We want it to be below 75, you feel me? Because that's one of the strikes we have. We bought an 85 strike and a 75 strike. We want it to be below 75. But because it's 250, I think I'm understanding it now. Because we paid 250 on it, our break even would be 72.50 because at least for the low strike. At least for the 75 strike, our break even will be 72.50 because that is, it's 250 below the 75 strike. So, like, that's gonna break us even on that. The break even on the 85 strike will be 82.50. So what's our median, break even? Because if it's 82.50, that means we made 250. But that's how much we put on it. So it ain't a profit. But if it's 80, then that means we made 450. You feel me? So we made 200. But we still lost, 500 on the 75. Well, kind of, we lost 250 because we put we lost 60.
Basically, that math that you do in your head, we gotta get that one.
We gotta get the equation because I don't really know what I'm talking about. I'm trying to make sense of it.
But you're building it.
I'm getting somewhere. Right. I'm getting somewhere, but I don't really know because it's like it's weird. So we buy a 75 strike and an 85 strike. What's our actual?
Let's watch that. Let's watch that last.
Let's listen again.
Not even that. We're gonna listen again after, but let's watch the video with the video I sent you when he breaks down.
Shows the vertical cost spread.
Yeah, and then just kind of like plot our numbers.
Put our numbers in there and figure it out.
For that.
All right. And also, we might have to send some questions into the options boot camp. See, like, we're confused, but I think once we figure this out, and then we can learn how to do vertical spreads and even short spreads too. And learn break evens and profits and when we need to get out, because we want to get out and get money. Or if it's going against us, if the stock keeps rising, we want to know, like, all right, it can't go above 90, you feel me? Or it can't go above 87. We want to know that. We want to know when should we get out, on the buy side and on the sell side. You feel me? Or on the profit side or the loss side, we need to know when we need to get out. And we don't necessarily know right now, but we're going to figure it out. So that's where we at right now with the.
All right, so pause it, and then we could just come back.
Yeah,
we'll come back to you.
We're gonna come back.